All right, so let's take that in two parts, Professor. The idea that he says, quote, it feels exactly like 1999. Do you agree?
No, I don't agree. I mean, and Tom Lee was talking about forward PE ratios. Forward PE ratios on the S&P, including Mag 7, are about 23. If you exclude the Mag 7, you're down to about 19 and a half. Back then at the peak in 2000, they were 30 going forward. The interest rates were much higher. In fact, back then you could buy 10-year TIPS, Treasury inflation protected securities, get over 4%. Today you get 1.7%. I mean, the alternatives are not anywhere near as good. No, I mean, some people say we're like 1997, which it was in December of 97 that Alan Greenspan talked about irrational exuberance. And then the market kept on soaring in 98, 99, and it did not peak until it reached crazy levels in 2000, and we are not at those levels.
The second part, of course, of Paul's point, and maybe the most salient one to my next question in our conversation is, yeah, it feels exactly like 99, but I'm paraphrasing, of course. I'm no dummy. I mean, you saw what happened from October of 99 until the spring of 2000. So why wouldn't you be positioned for a much higher stock market from here? Is that how you see it as well? Lean into this market because we're going to have a big upside from here?
Absolutely. I mean, the momentum is a very powerful factor, and the momentum is there. I do want people to understand, and it's been said before, but I think it bears listening to. Wall Street and Main Street are not the same. We were talking about how strong is the economy. Should the Fed cut? I think the gap between Main Street and Wall Street is getting greater and greater. You have AI pushing, a group of stocks that is 25 to 30%. The AI hires, employs about 1% or 1.5% of the U.S. workforce. And all the other companies that aren't really doing very much are employing the other 90%. So, I mean, we have a big gap, I think, between these two. And AI can continue to soar. An indexed investor can continue to do well, even though the economy, I think, is facing some challenges. First of all, government shutdown, I don't want it to last much longer. And I still think we have a question of how those tariffs might affect Q4 holiday sales coming up, how much price increases might deter individuals. I think it's a mix between, government shutdown, negative sentiment, and we are going to get sentiment tomorrow. That's not a government number at the University of Michigan. So I say that we have to be cognizant of the fact that economy, stock market, yeah, there's a big link, but there's also a gap.
Well, I mean, this was what I was discussing with Stephanie Link, who made the point earlier on the program, whether you heard it or not, I'm not sure, that the economy is still strong, and so is the consumer. So we should be focusing more on that. There aren't as many concerns as some would like you to believe. It sounds like you disagree with that.
Well, no, we have strong investment. We strong AI investment. I don't think we're going to get the 3.8 on GDP. I think it's going to be in the mid-twos, but a lot of that's investment. And we also know that the consumption of the high end, the better off individuals, because their stock market is doing great, their bitcoins are doing great, property values are still up, their spending, the spending is pretty lackluster on the bottom half. So, when you say strength of consumer spending, you have to talk about which consumer are you talking about.